They're so much faster now. I eliminated one thing. Am I on? It's 8 a.m., December 20th. Good morning. This is the Gold Fix with Vince Lanci, uh, as hosted by Larry Benedict's Opportunistic Trader. The rundown today is going to go like this. We're going to go through very quickly where the gold price is today. It's up 11, 12, $13, depending on what minute of the time frame you're looking at, which is a big surprise. On that, I'll have to, as a subcategory of that, I'll have to go through the difference between facts, conjecture, and speculation, because it's actually kind of humorous. It's self-analysis. Second thing we'll be doing is we'll be going through gold yesterday. What happened to gold yesterday against the backdrop of the Fed and what we said was most likely to happen. And then third, we'll come right back to where the market is now, and we'll talk about potential reasons for the rally, and give you some technical numbers to get through the day, because it could be a good trading day, as opposed to just gapping up $12 and being done. All right, so you're looking right now at the Op Trader overnight recap, which I think is the best way to start the day today, after all the info and data thrown at you. You just want to have something straightforward to read some facts. Fed raised the target band for U.S. interest rates by 25 basis points. So while you're looking at that, I'm going to talk about the gold market. Today, gold is up $12. I'm not putting a chart up there yet because I have something set up, something special, an instant replay of yesterday's activity, a recording, so we can look at how the market behaved and kind of pause it at key moments during the day, and then talk about what happened and lead it into today. But gold yesterday, against the backdrop of the Fed and what we said. If you tuned in yesterday, and if you did not, I'm going to say it again, we handicapped a dovish hike. That was a subtle reversion than what the market was consensus. If you remember, we had like dovish hike was hike, or hike as Mike called me on yesterday in the AM roadmap, or basically a straight up hike. Then it was subtle dovish hike, and then it was more overt dovish hike. Then it was four. What was four? Four was something like an outright, we're not going to raise rates ever again. But we had handicapped a less dovish, but still subtle dove version of the hike, and then going chronologically from there, gold had been relatively strong for the past week. We had noted versus the DX, and that's in the micro movements, not the macro movements. By micro, I mean day to day, hour to hour. It had been acting a little bit strong relative to the DX, despite giving back a lot of the gains post our own buy signal 2 weeks ago. Let me get this real time. This is the Twitter feed on the left that you're looking at there. That's pretty much headlines and facts. It's not really deep stuff, but it's good for real time information. So gold had been acting relatively well versus the DX. On a micro basis, but it had given back a lot of its gains on the buy signal that we had gotten 2 weeks ago. And so we were saying, it's still long above 1233, but I don't feel so committed. If you remember during the day yesterday, and we'll go through this in the instant replay, gold spiked hard pre-Fed. This was, I believe, short covering. A lot of times before a number, the market will move, and conspiracy theorists will say, well, that's the smart money getting in because it was leaked. And you know what? That's true, folks. That happens sometimes. But yesterday, I think what we saw was weak hands that were waiting for the market to come to them, who threw in the towel, and they just covered. They're waiting for a dip, they didn't get it, and they covered. Then Powell speaks, kills the dove, and gold drops, and stocks drop more. And then I remember we said, I said, okay, representing my company, not Opportunistic Trader when I say we, Echo Bay Partners, but we'll just say I said, trade stocks if you had an opinion on gold. And that was right, meaning gold and stocks would be moving in lockstep because this was interest rate based. We basically said, if you're bullish gold, after the number, buy stocks. If you're bullish, excuse me, I'm drinking some coffee. If you're bullish If you're bearish gold, sell stocks, and that was right. And then I added a little phrase at the end there that just bit me in the ass, and I shouldn't have said it, but I said it and I meant it, and that was sell gold tomorrow, because it, that's a cynical statement, meaning people sell gold the next day after the stock market uh, gets hammered because of they sell gold more so they can buy more stocks. But clearly, with gold up $12, that's not the case. So we'll get into that. Not too much, but just the point is, uh, that was just me being. That's a cynical old gold player saying, if gold sells off and stocks sell off the next day, stocks go back up and gold doesn't. That's a cynical statement, and it was wrong. Not wrong to say. It was wrong. Just it was a wrong. It was a prediction that was wrong. But I didn't trade on that. So, which is why I want to bring up the concept of facts versus conjecture versus speculation, which are legal terms, but I think are very important when you understand trading. A fact is what it is. Now I know with the whole fake news concept, what is a fact and what isn't. Facts aren't necessarily truth. But, I love to wax philosophical. We're not going to do that. Conjecture is an informed opinion. Conjecture based on information and observation and experience. I think it's a reasonable belief to think X is going to happen. Speculation is when my voice goes up an octave, because this morning gold, well, the voice in my head, I only have one voice, but the voice in my head, gold was up $12, and I went in my head, I just went up, like I got almost like a falsetto, and I went, we're going to 350, 1350. And I went, oh boy, that's speculation. So speculation is an opinion that's not informed. So back to, I think I actually called it our precious. Um, so we're going to get into the reasons for the rally and the technical numbers, but I want to do the replay from last night. And to do that, I need to do this. All right. Okay, so we're on a 15-minute bar on spot gold. I can't do this with futures. I can only do this with spot gold. And we're starting a little bit after. You see where the 19 is there? We're starting a little bit. Oh, my cursor's there. A little bit after midnight on the 19th. And let's take a look at how the market behaves. Okay, so now the market is choppy and lower. Okay, somebody sells the market off before, during London liquidity hours, and it bases lower. So basically, it gets slammed and then travels sideways after that as it absorbs the selling. So now between 6 and 7:30 a.m. is a less liquid time and not a time that you would normally trade. So let's see what happens next. Okay, all right. So now the market between in this time frame, right? This is when the stock market and the gold market spiked as high as 1262, I think, basis futures, and that was surprising to many people. Uh, uh, Stocks rallied as well, but I immediately called, in my mind, I called that a short covering rally before the information, and I put it in the chat, and I also put it on Twitter that there were a couple at some point on an hourly chart, which I can't change right now. Right around up here, there was the beginning of a bull flag. We had gone up, and then we had a bar or two down, and it looked like a nice bull flag for a move higher if you're a technician. But I also noticed there were longer wicks than this on the hourly chart, and I said, okay, so it's either the long wicks win on the bearish side, or the bull flag wins. And then the market dropped, so the long wicks won, and the momentum was killed. Momentum was killed. And this is still well before that momentum of that rally was killed. So the short covering was over well before the 2 o'clock announcement. So let's go to the 2 o'clock announcement. Okay, so there you go. All right, so this is the market. Okay, I'm still on a 15-minute chart here, but on the hourly chart, I'd seen this bull flag and these long wicks. But then the market came off, negating the momentum higher, which is fine. So now the market's basically saying we're waiting for the Fed. and it starts drifting lower. You don't know what to make of that. It could be just some longs puking that are throwing in the towel. Uh, it could be maybe there were some longs buying in here that changed their mind. Who knows? But then 115, 130, that's the 130, 145, and the 2 o'clock. Powell basically comes out, and I think this level here also coincided with Goldman putting out their red line, which was their version of the red line, which we posted in the chat room, was uh, 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 not dovish at all. And you can say what you want about Goldman to the negative. There's plenty to say, but every so often they still get it really right, and they were just spot on. So let's go through the rest of the day yesterday, and then see what happens overnight. So the market is now it's okay. Okay, so this is the sell-off, okay? And this is the bigger sell-off. Now you notice we have these long wicks. These are 15-minute charts. So it doesn't really matter to me in that respect. But um, basically, what you have now is you have a market that's just kind of maybe a little bit of a bounce, maybe some short covering, testing this candle here, and then we take off, and it actually goes parabolic on this 15-minute chart here. And let's just let the rest of this play out, and then we can talk about what's going on with the market today. Okay, so that's it. That's where we are now. All right, we'll turn off the replay and we'll go to the hourly chart. All right, this is what I saw. After that rally on the hourly chart, I saw this nice little bull flag after these two here, and we talked about it in the chat, and I definitely put it on Twitter as well. A couple quick charts, basically long wicks versus a bull flag, and of course the long wicks won. And of course, that's the cynical gold guy. Okay, that's the guy who's been trading gold a little bit too long. And then we have this big surprise. So what's going on here? Why is it going on? And you can't really say that you know why, but I can say actually before we get to that, um, shout out to the tweet this morning for Opportunistic Trader. The market is now pricing in a 50% chance of one hike in 2019. Powell said he expects two. So think about that. The market is still pricing in less hikes than Powell said. It's like the market thinks Powell is full of it. The market. Well, I'm not saying the market. People handicapping the market. The market said he was hoping to leave that out. The market was hoping he was going to leave that part out. So there you go. That's pretty funny. And then Tepper said the Fed put his debt. Tepper's a fund manager. If you don't know who he is, he could be talking his own position, but certainly he's someone to listen to. Uh, uh, and I would say the Fed put his not debt. If stocks go below 2,000, there's going to be some QE. So which brings us to why is gold higher? The answer is I don't know. Okay. And that's not something you hear people, and you're not supposed to know. You're supposed to never know. You're supposed to, anyone who knows has hardening of the brain arteries. You're supposed to think, and you're supposed to doubt, and you're supposed to handicap. But the DX is lower, right? But gold is, pretty violently higher. So, what are some of the reasons that gold could be higher? Well, here's one for you. After uh, uh, Powell's speech, market expectations for 2020 Fed rate changes went from basically unchanged to down almost 20 basis points. So this chart, I got this chart from Zero Hedge. Thank you for that. What I want to call that would be QE4. So the market is now discounting what goes up must come down uh, uh, in 2020. So whoever the president is in 2020, if this is right, is going to have a nice little gift, and that's going to be lower interest rates. So the question is gold rallying because of that? It could be, but I've said before, gold is a very poor discounter of future behavior on a continuous basis. It discounts 5 minutes ago. It doesn't discount, 6 months out or 12 months out. That's what the bond market is supposed to do. The gold market's just not big enough to do that. But, and I've seen this before, there can be unreasonable spikes in the market that people forget about a month later, uh, and then you find out, a year later that that was someone plowing in to gold and really didn't care about a $5 slippage on their fill because they were in it for the long run. So that's a speculation. I would like to call that conjecture, and it kind of is because I literally have seen that before, especially in silver, where the market would run up a lot on the close, and then uh, we would say, no big deal. And then, 3 months later, someone is selling, pushing the market down hard on the close. And we're like, no big deal. Well, that was the guy who took, $1.50 out of the market and didn't care about his 10-cent fill, getting in and getting out, because he was more macro. But so looking at this as a reason for the rally and tying that concept to what I just said, this could be a macro fund. This could be a gun lot getting in and saying, you know what? Okay, I just closed some profits on my short stocks. Uh, Buy me some gold. The market is six, but it's seven. Well, I want to buy 2,000. Where can I get filled? Well, you might move the market $7. Who gives a crap? Because it's going to 13.50. And I think one of our subscribers, XDM, uh, uh, although he's not saying we're going to 13.50, but it's certainly on the charts, and it's actually in one of my macro systems that if we settle on a monthly basis above 12.62, 13.50 is on the radar. But this is not a day trade. We're talking about day trading here, and we'll give you some levels for that in a second. So uh, this is, possibly one reason that the gold market is overreacting. The second reason that the gold market's overreacting is allocations are coming, guys. And what does that mean? That means uh, uh, banks are about to release to their institutional clients and their high net worth individuals their recommendations. And before they do that, for good or bad, they buy what they're going to sell. Really, kind of like that's what a business does, right? A business goes out and buys sneakers, or maybe they make them. Well, we won't use sneakers; we'll use something else, because I happen to know a guy who's in that business. Um, Goes out and buys something and resells it. That's a business. And these banks that put out research, the research, to the extent that it's objective, it's good. To the extent that it's also a marketing tool, it's not. But the reality is, if let's assume that the research is objective and it's good, a bank will buy ahead of their clients buying, not just to front run them, not just to take vig out of it, although that's a big part of it, but to have one price liquidity for their big clients. They want to be able to say, to a client like a Tepper, who says, I like your recommendation. I want to buy, 10,000, contracts in gold. They want to be able to fill him without moving the market or giving away, or having a lot of slippage. So far from defending banks that do this, but this rally could very well, and I'll put a bigger handicap on that. This rally could very well be banks. In fact, I'm gonna give this a 30 delta. This rally could very well be an overreaction to the dollar because banks have their allocations and they have their recommendations that are coming out for 2019, and they wanted to wait before they bought their own inventory, and or let out the recommendations until after the Fed. And boom, there you have it. If you know that an allocation is going to come out to put more money into gold next year as a recommendation, if you believe that, if you're bullish gold, then can there be any better time to buy than after the last Fed announcement, the last potential for Fed surprise, and the market drops? No, there really can't be. Uh, so uh, I'm going to say, again, I'm handicapping. So I'm going to say that I think there's a big chance that a big part of this is buying on the back of anticipation of the next year. Powell's over, the Fed's over. Let's move on. What's happening next? And you will frequently see, by frequently, I mean 2 out of the last 3 years, maybe 3 out of the last four, gold makes a low, maybe not the year's low, but it makes a low in December. And at that point, it starts being bought in anticipation of first quarter allocations going into the new year. So keep that in mind. Let's go to technicals for active trading. Um, I had started. This is that's today, and that would be something I I think he deleted this tweet. I had to save it. Feel the market. Don't just go with meaningless numbers. Good luck. Now, I'm not anti-Trump. I'm just anti a president making comments like that. I think he should keep his powder dry, so to speak. Speaking of keeping his powder dry, yesterday was a good example of that. We spent hours, primarily Larry spent hours yesterday talking to people about, vol would underperform. It did grossly before, during, and after that he was bearish on the market. But just because he was bearish on the market doesn't mean he wouldn't buy it. Just because he was bearish on the market doesn't mean he was going to go into the number naked short. He kept his powder dry. He traded once before, lightly to probably to shake, to get his toe in the water and get a feel going, and he booked a profit on that. And he traded once after, and that's fine. You don't have to have home runs on days like yesterday. You just know that you have incredibly high probabilities of making money because of the opportunity. In fact, I think one of his trades was a buy. This is a guy who's bearish, right? So after the number comes out, market sells off. He buys the dip. The market rallies. He sells. He takes a profit. So to have two winning trades, I think maybe one of them may have been 20 handles in the spoos. I'm not sure, or at least 10. That's good. I didn't trade yesterday. I was too busy babbling in the chat room and putting up things for discussion. So actually doing info job because they were busy doing a lot more. It was a busy day in the house. It was like a trading room for journalists. Okay, so let's look at this. Now this came in this morning, and I want to. We're running out of time, but I want to put it here. Okay, wait, nope. I did that again, didn't I? Okay, this is yesterday. The reason I'm putting up yesterday is because yesterday morning there was a phrase in here. If you're looking at red lines, when Michael puts out his report, I look at what's changed. Okay, but this is what he changed. Okay, here we go. The decent break above 1247 now projects this upward for a likely run for recent new highs, and possibly, and this is the phrase that I saw yesterday, and possibly starting this in a new bull structure. And and he's basically saying if the market breaks new highs, normally I would see a lot of make sure you take your profits in that area, 1260, 1250 first, and 1260. But this phrase was a new phrase for me to see, possibly starting this in a new bull structure. So that's yesterday. We go to today, and here we go. So we're in the beginning, possibly, of a new bull structure. And by structure, it's a technical term for him. He uses trend lines and things like that. But the upside, get long above 1262. Downside, if we break below 1245, that's your range. That's a wide range, 1245, 1262. And right now we're trading around 1259 and a half basis futures. Okay, so we're close to the highs. He's saying, get long above 1262.20 and look for continued strength to come in. If we break above here and back below, look for pressure to come in. Now, jackasses will say, well, that's just saying if we go up, we'll go up. If we go down, we'll go. No, it's saying if we break above it, you get long and you find a stop that you put in. If we break above 1262.20, you go, okay, I'm going to buy it, and you buy it at 1262.30. And you say, well, how much can I risk? What's my stop based if I'm wrong? Well, your stop can be based on technicals, or your stop can be based on how much money you're willing to lose. So, you buy one lot, you're only willing to lose $100 in futures. So 1262.20. Let's say you buy it at 1262.20. You say, well, I can only lose $100. That's the amount of money I'm willing to lose. That's because that's my risk rules are don't lose more than 1% of the amount of money you're trading per day. And so $100 would happen to be 1% of the money I'm trading, let's say. So 100 out of $1,000. So that immediately says I bought one lot at 1262.20. My stop is 1261.20. Period. End of story. That's how it works. This is not an ambivalent thing. He's giving you levels that are likely to be repelled. He's not saying if we go above it, we're going above it forever. He's saying that 1262.20, for whatever reason, is an important number that the market will not sit at. So above 1262.20, look for continued strength to come in. Buy. If we break above here and get back below, okay, Where back below do I sell out if I'm long, Michael? Well, that's your job to figure out, jackass. You got to figure it out based on technical analysis, which could be his numbers, but it could also be, if you want to rely on his numbers for the downside, you'd have to know the rest of his numbers, which I can't show you. But if you rely on his numbers, as opposed to the amount of money you're going to lose, then you change your volume to reflect how much money you're willing to risk. So if he says get long below 1262 and risk a $10 loss, then I don't know what's going on here, but someone is about to come to my office. Anyway, so you can see the rest there. We're going to call it a day. And thank you very much. Good luck out there.